policy stance, the Fireside Dialogue provides an opportunity to engage in an open forum on perspectives regarding our monetary, exchange rate, and financial stability frameworks, including their impact and alternatives. Similar to the previous years, the 2026 Monetary Policy Statements evaluates our performance, assesses our strategic priorities, and in turn, articulates how the bank intends
to navigate the complex environment we are in. Notwithstanding the complex and uncertain economic and policy environment, it is imperative that our policies remain forward-looking, evidence-based, and aligned with Botswana's broader development aspirations. Distinguished guests, the 2026 Monetary Policy Statement sets out the foundations for doing exactly that and represents a critical aspect of policy formulation and contribution to desired inclusive and sustainable economic growth. Now on the ranked dual mandate of the bank. Distinguished guests, it helps in this regard to reiterate the bank's role as provided for in the Bank of Botswana Amendment Act of 2022. The primary mandate is to achieve and maintain domestic price stability. Simply put, preserving the purchasing power of the pooler. The complementary responsibility is to promote financial stability, provided that doing so does not conflict with the primary objective. Central to the bank's pursuit of price stability is the medium-term inflation objective of 3 to 6%, which serves as the benchmark for calibrating monetary policy decisions and anchoring inflation expectations. In fulfilling this, monetary policy formulation also considers developments relating to stability of the financial system and prospects for sustainable economic growth. Distinguished guests, a sound and resilient financial system is critical for effective transmission of monetary policy signals, facilitating the flow of funds and liquidity, as well as risk mitigation in support of productive economic activity. In this regard, price stability together with conducive monetary and financial conditions foster effective mobilization of savings, productive investment, prudent allocation of credit, international competitiveness of domestic firms, and ultimately sustained economic growth. Botswana's exchange rate policy framework remains a critical pillar of macroeconomic stability. The pooler is managed under a crawling band arrangement that allows the exchange rate to adjust gradually in line with inflation differentials and external and evolving economic fundamentals, thereby helping maintain external competitiveness while cushioning the economy from adverse global shocks. Distinguished guests, any adjustments are undertaken at half-yearly intervals and publicly announced in the interest of transparency and enables informed economic decisions. I will now give an overview of the 2026 Monetary Policy Statement. Director of Ceremonies, distinguished ladies and gentlemen, dear colleagues, the 2026 Monetary Policy Statements reports on economic and policy developments in 2025, a year marked by significant policy adjustments aimed at restoring macroeconomic balance and strengthening policy transmission. It also evaluates factors driving price developments. In addition, there is an assessment of economic and financial developments that are likely to influence the medium-term inflation trajectory and the bank's policy choices in 2026. On external economic developments in 2025, the global economy remained subdued due to the lagged effects of restrictive monetary policy stance adopted in 2024, persistent trade tensions, and policy uncertainty, particularly surrounding policy choices by the United States of America, geopolitical conflicts, extreme weather events, and weak underlying productivity growth. Consequently, growth remained modest and uneven across countries and regions. Thus, according to the International Monetary Fund World Economic Outlook, global economic growth is estimated at 3.3% in 2025, the same as in 2024. Global inflation moderated from 5.8% in 2024 to 4.1% in 2025, consistent with subdued economic activity and easing cost pressures. This moderation, which involved a broad-based decrease in core inflation across regions, was mainly due to the slower pace of monetary policy easing since 2024, which kept interest rates at relatively high levels. Lower international prices also contributed to the easing of global inflation. Now turning to the domestic economic developments in 2025. For Botswana, as the Honorable Vice President and Minister of Finance indicated in the 2026 budget speech, the domestic economy is estimated to have contracted by 0.4% in 2025, an improvement from a larger contraction of 2.8% in 2024. This moderation in downturn is mainly due to stronger performance in non-mining sectors. However, domestic economic conditions remained challenging, particularly due to lower diamond revenues, constrained fiscal injections, tighter liquidity conditions, and generalized lower productivity. At a global level, monetary policy in 2025 involved cautious and differentiated easing across countries, reflecting variations in inflation dynamics and pace of economic recovery, as well as financial stability considerations. Several central banks loosened monetary policy in 2025 to support economic activity against the backdrop of an anticipated economic slowdown and a continued improvement in the inflation outlook. Some central banks, however, such as the Reserve Bank of India, faced renewed inflationary pressures and adopted a tightening stance.
Esteemed guests, regarding domestic monetary policy in 2025, implementation was against a challenging environment characterized by weak growth, changing liquidity dynamics, and heightened uncertainty around traditional growth drivers. The bank maintained the monetary policy rate at 1.9% in the first 4 meetings of 2025, following a cumulative 50 basis points policy rate cut in 2024. Distinguished ladies and gentlemen, this stance was consistent with the bank's commitment to support economic recovery while preserving price stability during a period of structural change in the economy.
However, monetary policy implementation was tested by unprecedented and persistent lower liquidity levels, largely driven by a slower fiscal injection into the banking system, reflecting reduced diamond earnings and related subdued government spending. In turn, the lower liquidity level elevated the funding concentration and uneven liquidity distribution challenges. Thus, intensified competition for deposits resulted in wholesale deposit interest rates rising markedly and contributing to upward pressure on prime lending rates, which rose from 6.01% in December 2024 to 7.19%. This created a disconnect between monetary policy stance and market lending conditions, with potential implications for credit affordability and growth prospects at a critical juncture for the economic transformation. To address the disconnect, the Monetary Policy Committee recalibrated the monetary policy rate upward by 160 basis points to 3.5%, while simultaneously directing commercial banks not to raise their prime lending rates further, with a view to preserving credit affordability and avoiding an excessive tightening of financial conditions. This action was therefore not a tightening bias, but a corrective recalibration aimed at reinforcing the effectiveness of monetary policy framework and restoring orderly transmission, particularly in relation to the monetary operations tools and distribution of market liquidity. I will now turn to discuss the monetary and related operations in 2025. Distinguished guests, the monetary operations reforms introduced in 2022 continue to yield positive outcomes, with the interbank market rate consistently trading within the standing facilities corridor, thus an appropriate anchor for monetary policy transmission. Open market operations in 2025 were conducted in an environment of structurally tighter liquidity conditions relative to previous years. Excess liquidity moderated, largely reflecting foreign exchange outflows and slower government spending amid persistently weak diamond revenues. Notwithstanding, excess liquidity continued to persist in the system, and liquidity mopping dominated the conduct of open market operations through Bank of Botswana certificates. However, as I have already alluded to, structural features of the commercial bank's funding profile, such as deposit concentration and uneven liquidity distribution, continue to pose challenges and manifested in weakened policy transmission. This, therefore, necessitated additional interventions to support efficient market operations and safeguard the effectiveness of monetary policy transmission. Thus, the tenure of the repurchase agreement was progressively extended from overnight to 3 months to improve funding predictability, support asset liability matching, and reduce rollover risk. In addition, the credit facility rate was reduced from 800 basis points to 300 basis points above the monetary policy rates to discourage precautionary liquidity holdings. These measures aim to enhance liquidity distribution, stabilize short-term funding conditions, and reinforce monetary policy transmission. Now turning to the exchange rate policy.
Parallel to implementation of monetary policy, the bank also implements, on behalf of government, the exchange rate policy.